Only 4% of the time do stock markets do this. Yes, hello ladies and gentlemen, and welcome back to another video. Today we talk about retail traders placing super bearish bets on the markets. And the unfortunate news is that often we get squeezed when this occurs. When there's so many people going in one direction, markets tend to go the opposite way. And with breakouts happening in the last 24 hours across the NASDAQ, S&P 500 and many other markets, we have a lot to discuss. What happens here in Q1 end is very important because it leads into not only a new earnings season, but more importantly, it also leads into the jobs numbers and some interesting stats about Q1 and December bottom lows. Let's talk about all of that and more in today's show. See you soon. Well, welcome back everyone to the Daily Show where we talk about the macro news, leading indicators and everything else. If it's your first time here, welcome. Consider subscribing and smash that like button if you enjoyed today's content, and hopefully you'll learn a lot. So we'll start off here with tech stocks. Of course, everybody's jumping into them, and it seems like there might be even further squeezing going on based on the amount of puts that we see outstanding in these markets. So is it a good time to buy them as an investment? Well, it's okay. It's basically the average price as we've looked at from a while. But a lot of analysts are now starting to say, well, wait a second, you've got to consider the risks of the future. And we've spoken a lot about that. This is no doubt going to be a kangaroo style market year. And that's because we believe here on the channel that the Federal Reserve and the market are going to have a little bit of a fight later on as the Fed move to pivot, but not cut as fast as the market expects. We're also getting another bunch of layoffs coming. EA is now laying off another 6% of their staff in cost-cutting pushes. Now, this is leading to, really the bottom line looking better for companies as they cut the fat, being us, realistically the workers, a huge cost on those businesses. But it does show you that now big business is starting to get worried about the upcoming credit crunch in these markets. So let's talk about this chart. Small traders are betting against any kind of rally. Well, we've had this quite a lot throughout 2022, and we've reached many times where we've had too many retail puts in the markets. And I think everybody that's been watching this channel for a while would know that generally speaking, when there's too many puts in the market, markets tend to rally for that period and they dip once everybody gets the FOMO and the calls back in. We only see this happen 4% of the time, and the annualized returns are 60.4%. Now, that's incredible when you think about it. That basically means that if you bought here based on all these puts over time, in general, the positive is massive for markets. The upside is huge. Now, I don't know if it's going to be like that, but here are some other readings. We've got the robo put call ratio, which is dropping down to this 0.8 ratio here, or really going back up to 0.8 ratio. Now, we only see this happening 7% of the time, and again, some mega annualized returns. And what you'll notice is that this is something that's been pretty much happening throughout 2022, and it's what's been stabilizing this market. Too many bears in the market, too many small traders trying to short it off, and that's causing a whole bunch of issues. If you're interested in these charts, remember to follow in the links down in the description below our Twitter over the link tree, and we share those pretty much daily with a whole bunch of macro news and all those types of things. Let's have a look at small spec index positions. Well, again, people just starting to place huge shorts. Look at the drop off here. We were on the rise and we obviously saw the FOMO return during January into the start of Feb. Then it dropped drastically and very quickly we went back into these negative 40 readings, which again shows us what? Well, it tells us that the retail traders out there, you and I, are basically trying to short this market, and in general, the market tries to squeeze that. We've also seen a lot of put activity on things like the financial sector. I don't think that's any surprise. And here is the chart that we've been using a lot as well recently, which showed us a few weeks ago when we were trying to buy those lows that basically dumb money was freaking out and smart money was realistically buying hugely. Now, we've seen smart money stabilize at pretty decent inflows, but at the same time, dumb money is now starting to buy the dip. They're starting to buy these breakouts. And this is pretty typical, usually around halfway through. If you think about it, here's the base structure. Here's where dumb money kind of starts going more positive. And you can see there's still a bit left usually in the tape. And I think that's the important thing. There might be a little bit more left here, but for how long can we remain bullish? So we'll talk about the charts later on, but yes, we're seeing dumb money repurchase, and we're also seeing way too many retail traders with probably outstanding puts in these markets. So let's talk about holding the December lows. It seems unlike some black swan event We're probably not going to go under where we were last year in December. And we got close to it during this banking crisis, but we didn't go below it, basically. 94.4% of the time, this has led to a bullish style market. So with puts, with all these things, you could really make a case for being bullish over the next 12 months, even with the problems that are going on. It's always better to be an optimist in markets, there's no doubt. And while I still think that we will go lower at some point and markets will turn around as the Fed and the stock market have a fight, which we'll talk about later, it does show you why being a bullish optimist does pay in these markets. I mean, they're basically rigged towards the positive side. Remember, 60% of the time, markets are bullish. So if you think about every single day in time and you bought every single day, basically 60% throughout history is positive. And that's kind of almost rigged in your favor in terms of the buy side. Of course, you can get stuck in bad times, but yeah, it's harder to be a bear than it is being a bull. So when we see these types of readings and we don't get new quarter one lows like we did in 2022, we tend to go into pretty positive periods of time. Now, the average return here is like 16+% for the S&P. Will it happen like that again? It could. But at the same time, we might get a bit of kangaroo style market action for at least the next 3-6 months as we find out what the Federal Reserve is going to do and whether they're going to cut in line with the market's expectations. We've also got insiders buying certain stock sectors. In notables, I guess, would be staples, XLP starting to get purchased up. We're also seeing financials starting to get purchased up by insiders. They're liking these cheaper prices, and I guess that makes sense. We do need to be very careful in the financial sector because it's going to be regulated. So now that we're going to see further regulation coming through, that is going to put pressure on earnings, and you have to be making sure that you're very well aware of that if you're going for that sector. So a lot of people are pointing out this, and yeah, it's the April run. It tends to be a pretty nice April into kind of July run during the years. And if you go and you can cherry pick this data a little bit, you'll usually see April into May being a fairly positive time for technology stocks and for that particular sector. You often see it pretty good for the market as well. Now, did this happen in 2022? No, it didn't. Does it happen most years? Yes. Is this the best month of the year that we're coming into? Historically, yes. And with the squeezes that we could put on from the put-call ratio, I think it's something important to keep in our minds. More importantly, though, I'm going to be looking at this, and stay tuned to this channel because we will be following the Federal Reserve's balance sheet incredibly closely this year. It's such a key thing. They claim they want to taper, yet they injected at a massive rate over the last couple of weeks. We will see updates to this. Have they injected more to this chart? If they have, well, let the breakout continue probably, because what that means is that growth stocks, which are positively correlated to this thing, could be on the rise even more. It seems utterly ridiculous, but let's face it, this balance sheet is an incredibly important part of technology stocks out there. And I've got our own way, of course, looking at it, which I'll be updating you guys if we see drastic changes. What I can tell you at the moment is it's stabilized. It hasn't actually gone up or gone down. It's stabilized through, and the injection remains. There's no tapering that I've seen occur just yet. And I will update you if I see the tapering, because remember, if we see markets going up and the tapering coming down, wow, that's a disconnect. And let's face it, the Fed is the buyer of last resort, so that's going to be a big thing. Now, a lot of people are making a huge deal out of US Treasuries being toxic. I don't tend to believe that. However, we are seeing, of course, big banks and big countries selling Treasuries pretty heavily. We've also seen a huge amount of sales that probably have to come through from banks. So I think that's something too important to consider and discuss. Now, why could markets also be going up right now? Well, I think it actually has to do with this. So we know, or at least a lot of people out there know, that the Fed pivot tends to bring negative markets. Why? They broke something. And even though they're pivoting and they're cutting rates or at least stabilizing rates, that doesn't mean the economy is healthy. As we go into earnings season, we'll probably start to find out that the cost cuts, at least firing people, is having a good bottom line. But it could be Q2 that earnings results that actually are the really nasty ones. Because when you think about it, at the moment, what the Fed's going to do is they're going to get up a little bit more, maybe go another 25 basis points, probably hold it based on the bonds market. We know they're going to pivot soon, but they tend to hold it for like 6 months. The market doesn't believe that's possible. Now, what happens with these Fed pivots is when they actually pivot, sometimes the market continues to go up for a little while. In fact, we showed this in a chart a little while ago where we had the market going into the Fed pivot, going bullish, then selling off. And I think this is an interesting story to remember. We all have to remember this. If markets continue to rally and everything looks great and it looks like it's not broken or it's all going to be okay and we get complacent and the put call ratios change, at that point, when you see the bearish price action, you need to be willing and able to strike. It's going to be difficult. Don't get me wrong. Everyone's going to be against you at that point. But if you've already been following the markets for a few years, think about the FOMO that everyone had in January. Harness that FOMO. Harness the way it was. Everyone, oh, it was so great. Markets are going up. It's fantastic. And then boom, 300 points off the S&P. So you just need to realize that it's about crescendoing fear and greed in these markets. And that's going to be an important factor. We're still betting on the recession side. Why? Bonds market are telling us. So bonds market is still telling us that a recession is coming and that people are getting complacent. Now, we find ourselves basically here with a little bit of an uptick now. So we're following, more likely than not, the no recession path. Now, that's never happened when we've had CPI, when we've had inflation this high. So I think the market is again turning a little bit complacent here when we think about it. EPS growth is turning negative as well, something to keep in mind. That usually means that there's kangaroo or down style markets after this. This is the notable kangaroo market, which was the 15-16 kind of period, and it went up and down quite a considerable percentage over that time. Do remember as well, if recessions come, ERP generally rises. I keep bringing that up just to remind ourselves that that is how things occur. Let's look at the rotation, though, over the last 5 days and the last single day. I mean, it was all about technology and realistically growth. Maybe the balance sheets increased because semiconductors, TAN, technology, consumer discretionary, they were the best 24-hour results, super hot there. And if we go over to the last 5 days, we still have a weird market. We have a market mixture with technology and staples. So we're still seeing utilities, which is one that I've highlighted recently, utilities and staples in particular, as having a stronger average period time. And they're going up while tech's also going up. And they're not super outpacing tech over the last 10 days, obviously, but they're certainly keeping up with technology in a way that's kind of almost disturbing. We've got a defensive nature in this market that's also buying growth, which is most likely squeezing retail, and also retail are in it because the Fed balance sheet has increased. So it's a very strange market. And I think that when we get the Fed complaining with the market itself, and that is the pivot technique and how long it might take them to actually start cutting. Remember transitory inflation. That took a while for them to realize it was bad. I think the market might crack it. Again, put your comments in the description down below. It will be interesting. So just before we jump into the charts and we take a look at all of the hottest levels that you need to be watching right now, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now it's all happening again. Yes, earnings season. Yeah, it's only a few weeks away and it all kicks off on the 14th of April. You need to be aware of the big earnings and more importantly, getting the feeds, which Tiger Brokers has now built into their calendar spreadsheet with their new updates. This means that every basically a minute we get updated feeds that come from premium services such as Reuters and others. And more importantly, we know when these big announcements are happening. The report announcements, which you can select from daily, weekly, or even monthly view. What's better about this is that you can get rid of all of the useless information you don't need. If you want to trade the US market, you've got it there. If you want to trade Singapore and get earnings, you have it there. Australia, your watch list, or even just the positions you have open. This is targeted to whatever feed you need, and that's, I think, very important. Also, dividends can be selected, and you'll notice that it then selects all of those as well as along with IPOs. There's also a bunch of key statistics that come up, live news feeds for certain companies, and of course in your watch list. And more importantly, you can get a bunch of headlines which allow you to then go through and check out all of the financial reports. So if you haven't considered Tiger Brokers, what are you waiting for? Check them out. We have a special agreement with them, which gives you a bunch of special offers if you're from Australia, and I believe the New Zealand audience, additional $30 worth of Tesla fractional shares for a limited time only. All you need to do is open an account and fund with as little as 1 cent. You'll be able to get all of those extras into your account. And do remember, Tiger Brokers win a bunch of awards, especially here in Australia, for their excellent application and all the extra services. For anyone else out there in the world, if you want to look in the description, they're probably available to you. And of course, for people that are not in the country specified, you can always contact Singapore if you're interested and see whether they would be able to set you up. Thanks so much for watching. let's get into the charts. So let's now jump into the charts, and we'll start off here with the US 2-year versus the Federal Reserve funds rate. Now, I only bring this up because remember, when the 2-year goes underneath the funds rate, that generally means a pivot is coming. But why are we even looking at this chart? Well, it's the time of the pivots in the average past history that I think is really important. We tend not to see so many rate cuts. And I think this is the big thing. It takes sometimes on average 6 months before we see a rate cut. Now, what does the market think about this? Well, if we push out to December of this year, we're already pricing in multiple rate cuts from the current rate. We don't even know we've hit the full pivot yet. I mean, it may be that we go 5.25, then pivot, then potentially rate cut. Remember, economists are like 50-50 on this. So we're just going to say no one has any idea about it. Let's just assume that it's going to be 5.25. They're going to go hard, try to stop this inflation, and then hold it for a period. I doubt the market's right on this. For the Fed to cut twice between now and the end of the year seems, or even 3 times, seems unrealistic. And I think the market will crack it if they don't get what they want from the Fed. Let's have a look at the last 24 hours because we saw major moves, or when I say major moves, decent percentages up on indices, and that led through also high yield junk bonds. So junk bonds where we're going up, and so was the market. That's usually a positive correlation with more of a true move. We saw treasuries kind of holding around. I'm sure there's a lot of bank balance sheets being sold there. And we saw an interesting thing happening with the US dollar. So the US dollar is back to finding that strength. And we reported on this in the last 24 hours. I assumed that the US dollar would find strength. And it's because I think we're stabilizing on yields. Basically, the market's starting to say, well, maybe you're not going to cut as much as you think, and maybe we're going to have to go a little bit higher. Now, if we see rates going back up, we see the dollar start to strengthen and the stock market's going up. And then, of course, even if bonds go down after that point, there's going to be something that's wrong, and it's going to be stocks. So we'll have to be very well aware as these puts start to expire in the system, it opens up the window for us to sell back off again. And I think this is going to be the dance into earnings and into non-farm payrolls, the jobs numbers that come out the next week and everything. So let's have a look at the dollar index, and we'll scroll in here. This is probably the one we got more correct in the last 24 hours. Now, it was a bit sneaky. It actually took the lows down here. And in the private community, I was doing a live stream on at the time, and I was like, wow, that thing is absolute. That's a cracker level. Like, to hit that zone, to take it, and then to show the reaction it did was probably pretty strong for the dollar. And the dollar has now moved above this area here. It hasn't cleaned its gap up yet. So I think if sells do start to occur back to like 102.60s, that kind of thing, or even a little bit lower, we should see resumption strength in the dollar. And I'd like to see the US dollar at least fill this gap. And this is in line with our thought process at the moment. What does that mean for gold? Well, gold's really boring at the moment, guys. It really is. It had an amazing run. It's consolidating at the moment. You'll notice I put a little trend line in just because it's there. 1976 is one of the most traded levels. So if it tests from the bottom, usually expect selling at around that point. Maybe not huge, but for day traders, you're going to want to watch the interaction with 1976. If we breach above 1976 and then pull back down, that'll be a good level to look for buys. I think that's one of the most traded levels through here. So that's going to be an important zone. If we start breaching down underneath this trend line, then where do we go? Most likely into those 1940s, 1937, maybe swing that low, could be a nice buy. So I think day traders will like this. Just remember, the middle of this range tends to be a great take profiting target zone if you're buying the bottom or selling the top. And for now, we don't have a clear breakout on gold just yet, but we will be updating you on the weekend video with the current flows from the biggest traders in the world. So do stick around for that. That's going to be a big one. Copper continues to kind of consolidate in our very much trapped zone. We've talked about it a lot, but basically copper's at resistance. I'd like to see it sell off here. That will show us a weakening in the economy. We'll find out whether it can do that. Natural gas. Now, I bring this one up from a monthly perspective because we are so close to cleaning up the monthlies now. This is a huge looking hammer, and notice how it pushes that very essence of the low. Now, if we look at the 2 hour here, it didn't quite get below my little level. So look at that. I don't know, some feeds probably did, depends on the blend, but yeah, 2.10. So we hit the lows. I still suspect it will try to take this bottom off. And then maybe you'll find buyers coming back through for natural gas, but be very careful of the Widowmaker. The stats point towards very nice history that shows you strong gains. but we need to find a base. And you'll see something, actually, I'll show you utilities later, and that's more of a basing structure. That's the type of way you want to see markets base off. Let's go over to oil. So oil sure saw some decline coming off this supply here in the breaker structure level. We like the idea that it could break underneath this 72,187. So that is move up below it and then rally and then hopefully sell off. Oil at a critical zone. Bears need to take control of this thing right now. And if they don't, 77 we go. And then they might be able to, have action. But at the moment, US oil's coming down. We need it a little bit lower. And then hopefully we can see a bit of a turn to the downside for it. Tesla's in the middle of nowhere land. We like down here, obviously. We like up here in terms of bears. If Tesla manages to get above 200 again, you can celebrate bulls. You can dance around and feel better about the world because that's going to be a pretty big breakout. Obviously, there's a little gap fill here you might need to be careful of, but overall, that'll be a huge move. It'll go above traded levels and it will show you that Tesla's ready to make its next move. I'm still thinking negative side, I guess, but that, it's timing's everything. So you've got to just be patient. I just set alerts down here. If it happens, it happens. If it doesn't, it doesn't. If you're trading down to that level, you need this thing to stop underneath 200. You do not want it to clean up that gap and go higher. If it does, bad things will happen. So yeah, we stacked this zone for the puts. We're not quite, we got sell off, sure. That's decent percentage. What is that percentage-wise? So it's about 6. 6 is okay, but that can happen in a few days at the moment. And look, realistically, it's just kind of looking like it's consolidating. Could that be a big flag moving forward? I don't really tend to believe that, but what I do think is it's clearly building a position for the next large move, and hopefully we'll find that using options, I believe, next week. Let's talk about Apple. Apple had a nice rally. Obviously, the markets did a lot of work in the pre-market session, and they did a little bit of work, further bullishness. This opens up gaps now. So we can delete this line because there's no real reaction there anymore. We're just consolidating. We now have this gap, which is a gap fill. And I really like the idea of doing something like this now. Based on what we've got with the put-call ratios, based on the strength of the market holding a nice bullish candle, you have to believe that markets will probably, if they dip or they fade, will be bought by rips. And that's just based on that put-call ratio stuff. You don't really want to go with the general retail public when they're all shorting. It tends not to work very well, and we're seeing that happen at the moment. Nvidia, another one that's left a big gap, and all these stocks are doing it. Nvidia is ridiculous, of course, but just because something is ridiculous doesn't mean that you can short it. And I've said that for a while. We do not have a short zone yet. And if this market does end up start bulling through and the Qs start making new highs and stuff, where do we go? Well, it's 289. Now, would I be bearish here? Oh, I'd hard press not to be. So you've got to pick your levels. But yeah, that's going to be important. Let's look at utilities. As I mentioned before, it was a really sneaky take the other day. It's been a huge couple of days of gains, big comeback here in utilities. So it's a nice base. It's actually performing pretty well. Volume's up. And theoretically, it should do well for the start into the middle of April. So I'd like to see utilities actually continue to find strength like it has been through this period of time. And it's not just utilities. We mentioned obviously staples as well. If you take a look at staples, pretty nice breakouts here and a couple of nice days of trade. So yeah, look, big volumes, people are liking it. Insiders are buying them as well. And defensive, they're defensive sectors. So if you're scared in the market, but you want to be long, some people sometimes go to defensive sectors and they still get decent gains, maybe not as much as your high growth kind of tech, but it's a different sector and ones that people don't often consider. Let's move over to the DAX. Decent breakout here. It got past the zone that we were talking about. The only way this is bad is if it instantly shorts, goes underneath this low, and then bad things will happen, because basically that would mean that this is a false break. So we do need to be careful about false breaks. You always do in trading, but that's the risks you take. This is a breakout for the DAX to the upside. Obviously, there's a huge amount of shorters here, and yeah, I think that they could be getting squeezed. So I think that at the moment, fades should be met by bulls, and we'll talk about that using the American market in just a few seconds. Australian market's doing nicely. This is for all the ASX buyers out there. This zone held for now. This was really a futures market trade. It broke out during the post-market of the Australian market, and it just kept rallying and rallying and rallying. I kind of feel like it's going back to this blue line here at this stage, 72.20, and it could even go as high as this trend line to test the trend line from the bottom up, which would be kind of in line with a lot of American tech stuff and American stuff in general. So yeah, blue line, maybe it's a little bit oversold, interesting level, certainly looking at that. Let's move over to IWM, the Russell. Russell had a pretty nice session on it, decent, not too bad. If we look at the Russell here on this particular market, we've got a fib going back to the 75, 78.6. So it's now or never for the bears if they're going to take this in control. A couple of nice sessions, obviously a very, very strong buy off on the bottom there. And it's above pretty much one of the most traded zones. I'd feel like the Russell should at least try to go for 1783 now. At this stage, again, sell-offs should be met by buy demand. That's the type of way I'd be looking at it. Let's have a look now at the Qs. So we'll look here at the tech stocks. Now, tech stocks actually closed. So this is a fairly decent close. It closed near its high. We found that wick. We just bought all the way through the previous session. So we're now given quite a few gap fill kind of concepts. So make sure you price them into your charts, and you can do that. I like just writing gap fill. So you can have that on your chart, and you should know where those are. So there's a gap fill that would occur. Again, if it fell back, would that make some sense? Well, we can look at things like putting fibs on there. And if we take like a fib of that last move, you'll notice it kind of comes back to an extreme low. So yeah, I mean, this makes sense. A bit of a deep pullback. At the moment, you're looking at this going, well, this looks fairly bullish. I mean, look at the weekly here. That's where the weekly is. Only a few days left on trade, so that'll be a big one. That weekly previously showed us there might be buyers around. And then if we look at the monthly, this thing's about to snap what looks like an incredibly bearish shooting star. So these are interesting times for the Qs. And the next couple of, well, literally the next couple of days are going to be very important to the closures. Let's have a look at the futures market action. Again, strong daily close here. Pullbacks should be met, you would think, by buy demand at this stage. Based on what we saw in the last 24 hours, it bulled up again. It closed above all of the wicks. Look at all the wicks. Wicks. Nobody closed above any of these points. Suddenly there is. Could it still be a false break? It's possible, but we'll use the S&P 500 to figure out more. So look at this SPY. Closes near its high. That's a bullish sign. It doesn't look bad. Now, of course, there is an expected weekly options high, which sits at that 405. So that'll be an interesting zone and not that far away. But yeah, gaps. Now we've got like a market that could come down, fill this area, and then still find buyers. And that's in line with a few things we'll look at in a moment. Again, SPX, you can see the close, the real market here. Nice close. We still have gap fills. We've got left over here, 40.90, most notable. And we'll load them all up onto the chart here and bring it all together. So the most traded level. And we snapped that off and we basically tested it, found very little selling there. We just kept buying through it in the futures. And then we closed above this level here, which is, of course, that 40.10. So 40.10's been snapped, and it makes you think that now if we get sell-offs, we should be looking at buy demand based on the put-call ratios that we now have the data on and everything else. You might not like it, but at least that's the way it looks. It's grinding higher, and it's not like a flag anymore. Like, I mean, that thing is massively on the wedge on the way up. So again, most traded level is here. Unfilled gap is here. There's plenty of lots of synergies down here, fibs, all sorts of things, trend line, etc. So if the markets do fade, I would expect buyers to try to plug that hole and maybe try to keep pushing it up. Now, where's problems? There are probably going to be some issues, though I'm wondering whether that's already been the issue with this 40.50 zone. I feel like markets should go back to 40.80 or even upwards of here, 41.34. Both of those levels are going to be where I believe the bigger bears sit, and especially this one up here. Most people won't see that, so we'll focus on that one should it come. Remember, you've got to be patient and you've got to react. I've been very skeptical of this week so far because realistically, it was trading right on an incredible kangaroo zone, so it's very tough to pick the direction. But now we kind of see these signs that, I mean, the market closed on its high, so again, dumps should be met by bull demand. Otherwise, that's completely false. And I don't know if it really is. Let's move over here to the options. We know 380 has lots of puts. We know 410 has lots of calls. And we know that if it closes pretty much between 390 and 410, the market will be happy. I don't think there's any problems about that this week. We're smack bang in the middle, giving Wall Street as much money as they can handle. 2.5 million units outstanding, and they're just smashing us every week at the moment in these options, in the options game. Bitcoin made a new high just then, 29,000. So we still want 30,200. Could that be the synergy with the stock market as well, hitting something like a 40.80, 40.90? Well, that's what we're looking for. Bitcoin, interestingly, took this high and then instantly rejected. Let's have a look at the 2 hour here just to check it out. So let's look at this time frame. So we instantly reject there. I think it's going to be interesting to see how this closes and how the market, if the market gets back above that level again, then we should be able to go to 30,200, because clearly up here, there was a big shorter that just came in, probably a lot of buys, and then they instantly squeezed all those back down, took out their stop losses that were here, and now we find out the real truth. So yeah, very interesting reaction here for Bitcoin. We've remained bullish on this thing because we're holding this level for now, which is 26,590. And there's been a whole bunch of FUD and all sorts of things going through. I still remain at 30,200 for this one. So we'll find out whether we can get there. And Bitcoin is powering on. Very, very interesting. I watch that candle quite a lot here. Let's move over to the news ahead and take a look at everything that's going on around the world right now. And if we scroll back into this week, we don't have too much coming out on the Thursday except for the final GDP number before the market. And then we have unemployment claims as well. So our first insight into the claims, Thursday, March 30th. Then we go to the 31st, which is the big monthly close. Core PCE price index is the big one, 8:30 a.m. New York time. Daylight savings time shifts for a few countries out there, most notably Australia and New Zealand. And then we go to the next week. Now, remember, this is where we get some economic news. So we finally see economic news in April. And more importantly, that's when we get those jobs numbers. That's one of the biggest economic calendar bits of information. The Fed will be using it, and we need to be on top of that one. So make sure you watch this channel or anything else. Make sure you're on top of that. The jobs number is going to matter. Remember, this is a data-dependent Fed, and the market will crack it if the Fed doesn't do what it wants. So it wants support. The Fed might not want to give it to it. It probably shouldn't, realistically. It's better to go through some pain. Maybe some of you disagree with me there, but I think it's better to put the pain in right now and deal with the inflation issue. Again, we're all open to opinions here, but like that's the way I see it. So I think they would stick with the side of history. They will stick to the pivot being held for a little bit longer. And if they make grave mistakes, it could go very bad. If you've enjoyed this content, consider subscribing, smash that like button, follow us over on the other socials, which you can look at in the links description down below. And of course, if you're interested in some free cheat sheets, you can sign up for those, completely free to do so. Also, big thank you to the sponsor of today's video, which is Tiger Brokers. Check them out, links in the description down below. Have a great day. Good luck trading out there. It's not easy right now with this tight range stuff that's going on. So stay safe. Bye for now.